Hi, I'm Larry Antonatis, Managing Director and Portfolio Manager with Brookfield Asset Management. The number one benefit of adding real assets is portfolio diversification. Real assets tend to behave differently than traditional equities and traditional fixed income. They have a moderate correlation to traditional equity and traditional fixed income. So adding these asset classes to your portfolio historically has led to an improved efficient frontier moving up and to the left. Infrastructure is very interesting and very different from most other things you can invest in. Almost everything you can invest in is driven by the laws of supply and demand, and where supply and demand intersect, that creates the market pricing. Infrastructure typically is very regulated. Supply is controlled by the government. Therefore, many infrastructure assets are actually monopolies or semi-monopolies. That's a terrific place to be, so that's a big advantage. If you think about demand for the services provided by infrastructure assets, they tend to be relatively steady because infrastructure usually provides essential services: energy, water, communication. Considering demand for infrastructure assets, the services provided by infrastructure assets tend to be essential services, so demand is very steady. Much of infrastructure is comprised of energy, water, and communications infrastructure, things that you will use every day whether the economy is good or bad. There's also a group of transportation infrastructure assets, airports, seaports, and toll roads, which do have GDP correlation. But in general, very stable demand for infrastructure services. So with those monopoly assets or semi-monopoly assets, relatively steady demand, let's now talk about pricing. So we've talked about supply, we've talked about demand, let's now turn to pricing. The government has given you a monopoly or a semi-monopoly, and in exchange, the bad news is they're going to keep a lid on your price. And they do that to ensure that consumers are paying fair prices for essential services. The good news that comes along with that is that while the government does control many pricing mechanisms, they tend to move those prices with inflation. And that really brings you to one of the second benefits of investing in real assets is inflation protection. If the government regulators allow prices to move up with inflation, your assets have growing cash flow and you have contractual inflation protection. Rising interest rates are generally bad for every asset because it raises the discount rate of the future cash flows. Rising interest rates are particularly bad for fixed income assets because they are fixed income. Many real asset investments are equity focused, so it may be REITs, REIT equity, it may be infrastructure equity. And you should think about those equities as being able to grow their cash flow over time. Historically, what we have seen is that rising interest rates generally coincide with periods of rising economic activity and periods of rising inflation. Therefore, they drive the cash flows higher. And if you look historically at the performance of real asset equities versus global equities, traditional equities, in periods of rising interest rates, real asset equities have kept up, if not exceeded, the performance of traditional equities. The real asset spaces of real estate and infrastructure are ripe for manager outperformance. These are specialized businesses, niche asset classes, and managers with deep knowledge of these narrow spaces tend to perform very well versus their benchmarks. In the liquid space, it's very transparent. You can look at the benchmark, you can look at your manager's performance, and you can see the level of outperformance generated by your manager. I think that is the best measure of the manager's expertise. If they can consistently outperform a benchmark, that is evidence of their expertise in this asset class.